Hello, and welcome back to our fourth video lecture. In this video, we're going to be looking at um, segments, right? Segments of a company, and we're going to see how do we prepare the segmented income statement. And we're also going to learn some new terms. We're going to have to differentiate between traceable fixed costs, common fixed costs, and we're also going to hear a word called segment profit margin. Okay, something new or segment margin rather, excuse me. Just a new term. As we go through this video, I just want you to think about a company that has multiple product lines, right? It could be a restaurant, right? That maybe has a restaurant on one side, and on the second side they have a bar. Okay. Think of any company that has two different product lines or two different segments. I don't know. I'm drawing a blank here. Pantene or whatever kind of shampoo and conditioner you use, right? Whatever company that makes that, well, they have two segments, right? They got one that makes shampoo. They got one that makes conditioner. So keep that in mind as we go through demonstrating how to prepare that segmented income statement. Okay, so when we're looking at segment reporting, really what we're talking about is a company that is decentralized, and they incorporate a lot of segment reporting, right? What is segment reporting? Well, a segment can be anything that we want, right? It's any part of an organization. It could be any activity within an organization. But we as managers, we need cost, revenue, and profit information about these individual activities or these individual parts, whatever. Okay, so some examples of when you would see segment reporting, right? Maybe if any of you guys have ever worked in retail, right? Individual stores could be reported based on segment reporting, right? What was this store's revenues, this store's costs versus store B within the same company, right? We can look at sales territory, right? The Northeast, the Northwest, the Southeast, the Southwest, Central, North Central, South Central, whatever. We can also look at it. We can also want segments from different service centers. Okay, so the key is recognizing what do we need to know in order to build this segmented income statement. Well, I'm sorry, but we're not going to get away from it. Contribution format statement or contribution formatted income statement, that will be used, right? Hopefully by now you've realized there's a lot of benefit or a lot of power from separating or segmenting segregating costs based on fixed and variable. So we're going to be still continuing to use that contribution formatted income statement. The second thing that we need to recognize when we're talking about putting together a segmented income statement is the fact that we're going to have two types of fixed costs. We're going to have traceable fixed costs, and we're going to have common fixed costs, okay? And we need to be able to first define what each of those are, as well as mechanically being able to identify, okay, this is a traceable fixed cost, this is a common fixed cost, recognizing that we have these two fixed costs that hopefully will allow us to contribute or to calculate that segment margin. Okay, traceable fixed costs or traceable fixed cost of a segment. It's a fixed cost, but it is incurred because of the existence of that segment. So what we're saying here is traceable fixed costs can be traced to a segment. If we get rid of that segment, if we get rid of that store, if we get rid of that sales territory, if we get rid of that service center, guess what? That fixed cost goes away. Common fixed cost, again, is a fixed cost, but This is a cost that supports the operation of more than one segment. Okay. For example, the CEO, right? Doesn't matter if we get rid of one segment, or doesn't matter which segment we get rid of, we're still going to have that common fixed cost of the CEO. Okay. So let's go through some more examples of traceable fixed costs, right? The salary for the Frito production manager at the Pepsi company, right? That's a traceable fixed cost to the Frito's business segment, right? If PepsiCo says, we're going to sell off Fritos, well, guess what? The cost of that production manager goes away, okay? Maintenance costs for the building where Boeing builds or assembles their 747s, okay? That maintenance cost of that building is traceable specifically to Boeing's 747 product line, okay? We could trace that cost to that type of airplane. If Boeing says, we're not going to make the 747 anymore, we're going to discontinue it, we're going to get rid of it, well, guess what? That building that we use, we don't need that building either. Why? Because we're not making 747s anymore. Okay. Some examples of the common fixed costs. Remember, those arise because the overall operation of the company, and this common fixed cost would not go away if we got rid of a particular segment. So we already used the example of the CEO, right? CEO for General Motors. It's a common fixed cost, right? General Motors has a number of different divisions. Well, if they get rid of one division, guess what? We still need a CEO to manage the other divisions. The cost of heating a grocery store. That's a common fixed cost to the various departments that are within that store. So think about the Giant Eagle, right? We have the deli department. We got the meats department. We got the the dry goods department. Well, if we get rid of one of those departments, the whole store isn't going to cease to exist, right? We're still going to have to heat the store. We're still going to have to cool the store. We're still going to have utility costs for that store. Just because we got rid of one department is really inconsequential to that total cost. Okay. Now, we need to recognize, how do we handle each of these costs, right? Extremely, extremely important in order to do this, that we understand, or we know that traceable fixed cost of one segment could possibly be a common fixed cost to another. What do you mean by that? Well, let me give you an example, right? Let's say that think of a good example here other than the one they give us. Let's just go with what's on screen. Makes it a lot easier. So they give an example of how traceable fixed costs could be common, right? So let's say the landing fee that an airplane has to pay in order to land at a specific airport, okay? Well, that cost we can trace to a specific flight, right? If we get rid of that flight, guess what? That landing fee goes away. But we cannot trace that cost to first class or business class or any of the classes that they have within the flight, right? Because think about it. If we get rid of first class, or let's say we get rid of first class and it's all like economy size, right? Just because we got rid of first class doesn't mean that landing fee goes away, right? That landing fee, based on those classes, is a common fixed cost. We'll get into more examples of these as we go through some examples. Segment margin, very, very important, right? What the segment margin does is it is basically the contribution margin of that specific segment, okay? So the segment margin in order to get it, we need to subtract out the fixed costs, specifically the traceable fixed costs, we need to subtract the traceable fixed cost from the contribution margin of that segment. Okay, this will allow us to determine in the long run how profitable is this segment. Okay, meaning we're going to see examples where we might decide to get rid of a segment. A segment's losing money, let's get rid of it. But should we? Well, it all depends on what is the segment margin. Okay, so great example here, visual representation. We got fixed costs, there's two of them, traceable and common. Common, again, we don't allocate those common costs to each of the segments, right? Because we can't. Why? Because they're common. If we get rid of the segment, that common cost still exists. Okay? So let's look at an example here of how we put this together. Okay? So we got Weber Company. They got two divisions. They either make computers they make computers and TVs. Okay? So we're going to look at one specific division. Okay? So notice what we have here. We have the income statement. Specifically, we have the contribution formatted income statement. Okay? So notice what we have here. We have the cost of goods sold. Remember, we're doing the contribution formatted income statement. That means we're only including the variable costs. Okay? We have the other variable costs. We subtract out all the total variable costs. We end up with the contribution margin. Then we subtract out only the traceable fixed costs. Okay? So remember, very important, kind of a side note, kind of something we should already remember. So it's probably redundant. Because we're doing the contribution margin formatted income statement, fixed and variable costs are always listed separately. Always. Okay? When we subtract out the fixed cost from the segment, those are the traceable fixed costs. We end up with the division margin or the segment margin. Okay? So we're looking at TVs and we see that, okay, the TVs have a segment margin or division margin of $60,000. Okay? What does that mean? That means that segment margin of $60,000 is what the television department contributes to the profit of the company. Okay? So what we have here is the total, right? We have TVs and we have computers and we have the company-wide. Okay, so we took the contribution formatted income statement, the total, and we broke it down into divisions, television and computers. Okay, so we see that the segment margin or the division margin, television is contributing $60,000. Computer department is contributing a segment margin or division margin of $40,000. Okay, when we add those two together, we get $100,000. The division margin is what goes to cover the common fixed costs and provide for net operating income. Okay? Remember, common fixed costs never allocated to the divisions, right? Why? Because they're going to remain if we get rid of division. Okay? So let's say, for example, that let's see an example here of how we can have the traceable fixed cost of one segment actually become common fixed costs of a smaller segment. Okay? So we got the TV division. Great. We can break this down further. We got regular screen TVs and we got big screen TVs. So notice what we have here now. We have just the television division's income statement, but we broke it down into regular and big screen TVs. Okay? So notice what we have here. The traceable fixed cost, those $80,000, right? We're saying that those fixed costs are traced directly to the television division. Okay, that 90,000 that let's go back up. That 90,000 of traceable fixed cost goes strictly to the television division. But if we break the television down even further, we find out that 80% of those costs can be traced to regular or big screen TVs. We find out that 10% of those traceable fixed costs are common to the television division. That means that within the television division, we get rid of big screen TVs. Okay, that's fine. We still have common fixed costs of $10,000. Okay. So now what we can do is we can go ahead and take that contribution formatted income statement and we can use it to make decisions. Okay. Think back to chapter 5. We calculated, or we saw how to calculate the break-even point and the contribution margin and all that stuff. So we can take those concepts we learned in chapter 5 and say, okay, what if we have an increase in a fixed expense, specifically a common fixed expense? Televisions, right? Advertising. Let's say we want to advertise our TVs more. Okay, this company, Weber, wants to advertise TVs. Well, that's a common fixed cost. That's going to benefit the regular TVs as well as the big screen TVs. As a result of this additional common fixed cost of advertising, sales are going to increase for both the regular screen TVs and the big screen TVs. Incidentally, the contribution margins of those divisions are also going to go up. As the contribution margin goes up, guess what else goes up? The product line margin or the segment margin goes up as well. Okay? So we could see that because the product margin line or the segment margin line of the products goes up, that amount is going to go to cover fixed costs, specifically those common fixed costs. Okay? So how do we compute the company as well as the segment break-even points? Super duper easy. We know how to calculate the company-wide break-even point, right? We take our fixed costs. This time we have to take total fixed costs, meaning we need the traceable as well as the common fixed costs. We divide by the contribution margin ratio to figure out what our break-even point is in dollars. Okay? Notice how we calculated the break-even point, right? Notice how we calculated the contribution margin ratio. We took our total sales of $500,000 and we pulled out our total contribution margin. So, total company-wide contribution margin divided by sales gives us our CM ratio of the total company. That's important, okay? So to figure out what the break-even point is, notice what we take, $170,000 plus $25,000. Well, the $170,000 is our traceable fixed costs. The $25,000 is the common fixed costs. So in sales dollars, that's what the company's going to need to sell in order just to break even, to cover their costs. We can also take it a step further. We can calculate break-even points for each business segment. How do we do that? Very easy. Within each segment unit, or within each department, whatever you want to call it, we calculate the contribution margin ratio. That is the sales of that specific department and the contribution margin of that specific department. So notice that in order to break even, the TV division has to sell $180,000 to cover their expenses. Computers, just to cover their break even, based on only computer sales of $200,000 and based on only the computer division contribution margin of $120,000, we can calculate our break even points. Okay, notice what fixed expenses we're using. We're using the traceable fixed expenses when we are calculating business segment's break-even point. Okay? That's pretty much it for this chapter. The rest of this is just kind of incidental. It goes into breaking down those segment margins, but we're going to see some examples of those when we go through the examples in the study guide. Okay, so thanks for tuning in. Our next video, we're going to cover the exercises that were assigned for the study guide. So please tune back in for that one.